The overall market has improved somewhat, even if only slightly. However, there are certain subsegments of the market that have not shown much improvement. The office sales and leasing market has shown some improvement, as well as the big box industrial segment. The latter has shown activity, although there are not as many deals as there are active players. The flex and the retail markets have shown a little improvement, although there is limited activity. The land segment has remained sluggish and is not expected to rebound until the end of this new year. If that is the good news, the better news is that the worst is behind us. There is no double dip, nor is there a commercial real estate bubble about to explode. Now it's only a matter of the amount of time it's going to take for the severity of what has happened to improve. The office market has seen good but slow activity over the past 90 days. The 60,000 square foot build-to-suit on North Front Street, owned by Vision Ventures, has been leased. There's been a land development plan for a multi-story Class A office building submitted for the southeast corner of 2nd and State Streets in the city. Giant Foods has leased 70,000 square feet of office space close to their current headquarters on the Harrisburg Pike in Carlisle. Throughout the Harrisburg area, there are other smaller deals of 15,000 square feet or less searching the market for new or relocations. We still have 550,000 square feet of A space and 1,375,000 square feet of B space in the suburban markets, in addition to 146,000 square feet of A space and 178,000 square feet of B space in the city of Harrisburg available. A space vacancy in the suburbs is approximately 10.5%, while B space is approximately 20.5%. Within the city, primarily the CBD, the A space is 6% vacant, while B space is at 9%. Net absorption throughout the market has been reduced to about 10,000 square feet of negative absorption. Suburban B space rates are between $13.50 to $16 a square foot, not including in-suite janitorial, while the A space is somewhere between $16 to $19.50 a square foot. A space within the CBD is running between $18 to $21 a square foot, including janitorial. B space is comparable to the suburban rates. Concessions still seem to be the rule of the day. The biggest concession is free rent, used to cover moving expenses. The free rent months are either added onto the back of the lease, as is typical and customary, or they may be given within the term of the lease if requested by the tenant. Sale of office buildings is pretty much confined to smaller buildings of 7,000 square feet or less. When larger buildings are being sold, they are being sold as investment properties with tenants in them. For these larger buildings, purchase prices are being established depending on the amount of vacancy and the amount of risk associated with a particular building. Typical sales reflect an 8 to an 8.59 cap rate. The smaller buildings are still able to maintain $100 to $110 a square foot because they have held their demand even while the market has been slow. To comment on our industrial segment, today we have with us Jeff Thomas, the Senior Regional Development Officer of First Industrial Real Estate Trust, with offices located in Harrisburg. It's a pleasure to introduce Jeff to you as he explains the condition of our warehouse market at this time.
The industrial market is moving in a positive direction, which has been the case over the last 6 quarters. It's just that the positive trend has been occurring at a very modest level. There is more activity now across the overall market than this time last year. In 2009, more prospect and tenant activity was seen in the larger deal sizes, 400,000 square feet and up, where companies were typically squeezing costs from their supply chains through facility consolidation and or for other locational benefits. Now we are seeing a steady flow of small and medium-sized users, as well as the larger users. However, for the larger requirements, they now have to consider build-to-suit options, as the large blocks of available spaces has been depleted to a very few. While it still remains a challenge getting deals signed, and they don't all get signed, there has been more deal activity in 2010, with nearly 2 million square feet of net absorption versus a negative 1.5 million square feet in 2009 and a negative 2.5 million square feet in 2008. The rates we typically see and hear now vary from $2.75 to $3 per square foot for B space, to $3.25 to $3.50 for A space. The amount being spent on tenant fit-outs by the landlord has remained fairly stable as contractors continue to compete hard for job awards. The market activity continues to improve as manufacturers have orders they are now sending to the market and need warehouse space from where they can be delivered. Remember, our area has about 150 million square feet in total warehouse inventory, with approximately 18 million square feet currently available. This time last year, there was nearly 20 million square feet available. Total vacancy in the warehouse market is about 12.5%, an improvement of about 100 basis points from last year. Deals under 100,000 square feet are also making a noticeable improvement. Rental rates in this segment can vary widely depending on the level of finish, where A space can be anywhere from $7 to $10 per square foot and B space can be $4.50 to $6.50 per square foot. Total vacancy in this market segment is a combined 11% for both A and B space. Concessions are not as severe as they had been for available spaces. If building owners are providing concessions, they are keeping them or the term of the lease short, as most everyone is expecting the market to continue to improve over the next few years. In 2009, typical concessions may have been 1 month free for each lease year, and perhaps including a very low starting rate to help affect the final decision of users. This past year, while free rent remains in play, the low incentive starting rates are a thing of the past. The market is improving, albeit slowly, and as the Senior Regional Director for First Industrial Realty Trust, I believe 2011 will experience continued improvement with positive space absorption, rising rental rates, and decreasing lease concessions. Also, investment and development activity will reactivate to more consistent levels.
Flex space is moving slowly with only slight activity this past quarter. Rates may have dropped a little bit to a range of between $4.50 to $5.50 per square foot, while previously they were between $5.50 and $6.50 a square foot triple net. Net absorption has probably dropped 50% to 20 to 30,000 square feet during the last quarter. First generation space is still sitting empty with a vacancy rate as high as 40% as the wait continues for its first tenants. Asking rates are still high, but landlords are more willing to negotiate, therefore dropping the rates. Currently, the office space component is between $8 to $11 a square foot triple net, while the warehouse component is between $6 to $7 per square foot, again on a triple net basis. The land market has not changed much over the prior quarter. There are still minimal land development plans being submitted. Again, people can buy cheaper and with less trouble obtaining financing by buying existing buildings and renovating them to suit their needs. Some of the retail players, such as the convenience stores, banks, and CVS, are still interested in corners at signalized intersections. They have the distinct privilege of now being able to buy those parcels at discounted rates over prior years. Thus, their movement in the land development area is still substantial when signalized corners can be found in desired areas. The commercial and the retail markets have been somewhat shaky as they experienced less consumer spending during the fourth quarter. The activity did increase just prior to the holiday season in late November as the Consumer Confidence Index picked up and retail sales started to move in a positive direction until the end of December. Even with this last positive boost in increased sales, the retail market still remains somewhat reluctant with new tenants and new construction. Current vacancy in small neighborhood centers is between 25 to 35%, while in the larger power centers it is probably closer to 25%, which is up 10 to 15% from earlier this year. Rates for the neighborhood centers have dropped from between $10 to $14 a square foot to about $8 to $13 a square foot. For most power centers, the asking rate used to be between $30 to $35 a square foot. That has come down, and now deals are actually being done under $20 a square foot. In the Silver Spring Square, the rates have gone from about $30 per square foot to $25 a square foot or less. All of these are on a triple net basis. During the first and second quarters of this year, the landlords were willing to actually provide tenant improvement dollars to attract tenants into their space. That trend has now subsided between the end of the third quarter and into the fourth quarter. Due to the cash flow situation, they tend to give more free rent but stay away from any type of tenant improvement dollars provided by the landlord to the tenant. So although the report is not great, retail is maintaining, if not showing a slight increase as rates get reduced. One trend, though, that you will see more of is a hospitality trend of more restaurants closing as the economy struggles and people are not dining out as frequently. As we look back over the year, especially this last quarter, only certain segments were performing at some level of success, although the success that was had was not at a high level. Other segments are just barely maintaining, and one in particular, land, is not doing well at all. I think we will see this activity of the various market segments continue as a recurring theme throughout most of 2011 until we get to the end of the third quarter and most likely into the fourth quarter. But the good news is that we are not moving backwards. The worst is behind us and we should now be focused on the next 90 days.